All right, today we are going to master a classic, but seriously powerful tool for any trader, the Hammer Candlestick pattern. It's a signal designed to help answer one of the toughest questions in all of trading.
You know the feeling, right? It's the ultimate challenge. Every trader has felt that pit in their stomach. You want to buy the dip, but you jump in too early and just get steamrolled. It's famously called catching a falling knife for a reason. But what if there was a specific visual clue that could help you spot a potential bottom?
And this gets us right to the heart of the matter, the bottoming out problem. Look, trying to perfectly time the absolute lowest price of a trend, it's just notoriously difficult and, frankly, incredibly risky. Of course, we all want to buy low and sell high, but that temptation to jump into a downtrend can be a fast track to some pretty big losses. What we really need isn't a crystal ball, it's a clue. A reliable signal that suggests the balance of power, the whole momentum might be about to shift from the sellers to the buyers. And that is exactly where the Hammer Candlestick comes into play. It's a tool that's basically designed for this very problem. Now, it's not a guarantee, let's be clear about that, but it gives us a fantastic visual signal that all that selling pressure might just be running out of gas. So what does this thing actually look like on a chart? Let's get into it and break down the specific anatomy of a hammer, because its unique shape tells a really important story about what's happening behind the scenes in the market.
Okay, so technically speaking, the hammer is a bullish reversal pattern. Now, there are two phrases there that are absolutely crucial. Bullish reversal, which means we're looking for the price to turn around and start going up, and the second is after a price decline. This tells you that context is everything.
To spot one, you're looking for three key things. First, you've got a small body, and it's hanging out right near the top of the candle's range. Second, notice there's hardly any shadow sticking out of the top, sometimes none at all. And third, this is the most important part, that long tail on the bottom, the lower shadow, has to be at least twice as long as the body. In fact, the longer that wick, the stronger the signal.
So what's the story here? Well, think of it like this. During this trading period, the sellers were completely in control. They pushed the price way down, creating that long lower wick. But then, out of nowhere, the buyers stormed back in with incredible force, driving the price all the way back up to close near where it started. It's a picture of a huge battle that the buyers, the bulls, seem to be winning.
Now you might be wondering, does the color matter? You bet it does. A green hammer is considered more bullish. Why? Because the buyers didn't just fight back. They actually managed to close the price higher than where it opened. A red hammer is still a good bullish signal, don't get me wrong, because of that huge rejection from the lows. It just hints that the sellers haven't given up completely just yet. Okay, so you've spotted a perfect-looking hammer. Great first step, and this is so important, you can't just trade on that signal alone. A hammer is a suggestion, not a certainty. Trading it blind is just a recipe for disaster. It always needs to be confirmed. And the number one piece of confirmation is context. A hammer that just randomly appears in the middle of a choppy sideways market, it doesn't mean a whole lot. Its real power is only unlocked when it shows up at the potential end of a long, clear downtrend. That's when it signals a real, meaningful change in market psychology. So how do we find that confirmation? Well, here's the checklist. First, check the volume. A big spike in trading volume on that hammer candle shows there was real conviction behind that buying pressure. Second, where did it happen? A hammer forming at a major support level, a price where we know buyers have shown up before, is so much stronger. The time frame matters too. A weekly chart hammer is a much bigger deal than one on a 5-minute chart. And finally, the ultimate confirmation for many traders, waiting to see the next candle close green and above the high of the hammer. And hey, if you want to build an even stronger case, you look for what traders call confluence. It's just a fancy way of saying you're checking if your other tools agree. For example, is your RSI indicator, which measures price momentum, showing that the asset is oversold, or is your MACD showing a bullish crossover? When multiple tools all point in the same direction, your signal becomes way more reliable. So we know how to find a hammer, and we know how to confirm it. The next logical step is, how do we actually trade this? Let's turn this signal into a concrete plan with clear rules for entry, exit, and managing our risk. When it comes to getting into the trade, you've really got two main choices. The aggressive way is to jump in the moment that hammer candle closes. This gets you a better price, but it definitely carries more risk. The more conservative way is to wait for that confirmation we talked about, that next candle closing above the hammer's high. You might get a slightly worse price, but you have a much higher probability that the reversal's for real.
Now this part is absolutely non-negotiable. If you're going to buy, you have to know in advance where you'll get out if you're wrong. The most logical place for your stop loss is just a little bit below the absolute low of that hammer's wick. Why? Because if the price breaks below that point, the whole bullish idea is completely invalidated, and it's time to get out and protect your capital. And finally, where do you take your profits? Well, one popular method is to use a simple risk-to-reward ratio. For every dollar you're risking, you aim to make $2 or maybe $3 in profit. Or you can look left on the chart and find the next major area of resistance, a price level where sellers might show up again, and set your profit target just below that.
Knowing the rules is one thing, but knowing the common traps and pitfalls is just as important. Understanding how traders often get this wrong will help you use the hammer pattern much more safely and, hopefully, more profitably. So think of this as your quick safety checklist. Before you even think about placing a trade, ask yourself these questions. Did I actually wait for confirmation? Is this hammer happening after a real downtrend at a support level? Is there high volume to back it up? And am I using this as just one piece of evidence, not relying on it in isolation? Treating the hammer as one clue in a larger puzzle is really the secret sauce.
You know, when it all comes down to it, using this pattern correctly is about one thing: location, location, location. The magic isn't just in the shape of the candle itself. It's about where on the chart that shape appears. When a hammer forms at a spot where multiple technical factors all line up, like a major support level or a key trend line, its predictive power just goes through the roof. So, the hammer gives you that first, powerful clue that a trend might be about to turn. But remember, it's just the first clue. So the final question I want to leave you with is this. Now that you have this initial signal, what other pieces of evidence, what other clues are you going to look for to build a complete, high-probability case for your trade?